All right, Portfolio Builder members, Merry Christmas. Today we are trading the TLT and GDX ETF. And GDX started to scream higher Tuesday and is continuing to do so today. And just to review our general strategy going into 2020, let me pull up a chart. Now, I do believe our profits are up a little more since I updated the screenshots, but to summarize, we're looking for a very bullish equities market going into 2020, which we've predicted since October with the announcement of the phase one deal. Now, I was skeptical that we would reach a real phase one deal. However, we have. So now our price target for the SPY is substantially higher. I'm not actually quite certain the exact top of the SPY, but I do have a much better idea of what will cause the SPY to eventually sell off. And so my expectation is the TLT, which represents your 20, 30-year treasuries, will drop to this 115 to 120 level into 2020. And at that point, I believe this is the most likely event that will break the stock markets back as yields get too attractive. And so a little later in the presentation, I'll show you some evidence that this is exactly what happened in 2018 and how it could easily repeat into 2020. So our basic strategy is to short the TLT with our inverted option collar until it gets towards this 120 level, and then to be long the SPY, emerging markets, as well as gold during this period of time. Now we're trying to accomplish a low volatility trading strategy, which essentially generates safe income with low drawdown. So to achieve that, we have to buy lots of downside protection at all times. So we do have a lot of people joining in. Welcome, and thanks for listening live. Okay, so let's review today's trade alert. The top of the trade is the text message we send out so you can take this trade on the go. And it reads, if you took the last trade per 100 shares of the TLT, buy to close your December 27, 134 TLT call, and sell to close your January 3rd, 137 TLT put. We almost hit a profit on that. But the TLT is being a little stubborn today. It's selling off, but it's still about 10 cents higher from where we took this position. Remember, we were betting down on the TLT, and we are doing that once again today. Now, the new trade, after you've rolled out of the previous trade and into the current trade, is to sell to open the January 3rd, 135 TLT call, and to buy to open the January 3rd, 138 TLT put. So if you took the previous GDX put from the last several weeks, you have no action today on your GDX position. That's up and doing very well. If you're new, you will want to add the January 10th, $28 GDX put option. So if we do summarize how our portfolio is performing today, we're closing out the previous week's TLT position for a loss of 12 cents. The math on this is that we started at 136.45 and closing it out today, we are at 136.54. And because we have the inverted option collar, this is not the outcome we desired. We collected $1.33 credit to open the position, and we've had to pay $1.54 debit to get out of that position. So that's your math on that position. GDX has been screaming higher, and we entered this position at 27.46, currently at 29.02. And this is just over the previous week. So we've actually been on a hold in this position for several weeks. If you're a new subscriber, you're actually doing better than I am, because I had you get in at a lower price and buy a cheaper $27 put. So you're actually doing better than we are, currently up 59 cents per share And this is on 3,800 shares. So we're up $2,242 week over week on this position. The SPY trade is doing well. We should see a larger profit come tomorrow because more of that option premium will have eroded. But the bottom line on this trade on Monday, we started at 321.55, currently at 322.39. We paid a debit of 54 cents to open that position. And if we had closed it today, it would cost another 5 cents to close it out. However, we're not doing that until tomorrow. And so in this trade, it's a tight option caller with a bonus that we're long the 323 call. So up till 323, the SPY will most likely outperform us slightly. But if we go beyond the 323 price, we could be outperforming the SPY. And this allows us to have very little downside risk because we own that 321 put, which is financed with your 322 short call. Emerging markets are headed up higher today as well, 44.83. Big news, China's starting to spend again, and they're laying out some massive trillion-dollar infrastructure projects. So this is good news. We now have the 4 largest central banks expanding their balance sheet and using aggressive fiscal policy. So this is very bullish for stocks and will continue to put a lot of pressure on the bond market. So we paid 61 cents for our downside protection when we entered this trade, and we could currently get out of that for 25 cents back, bringing us at a 26-cent per share profit on 3,800 shares in emerging markets, or $988. Our total returns at 15%, and what's important to point out is we've only had a maximum loss in a month of 1%. We've never lost capital over a 90-day period, and I believe we'll be able to close out December with a nice profit after being down slightly because of that trade war de-escalation that really did catch me a little bit by surprise. Now, our portfolio has done very well in the past during multiple types of market conditions, whether it was going down, up, or flat. We've been able to generate return. In December, when stocks sold off 16%, we made 1%. In May, when stocks sold off 8%, we pulled in a 2.2% return. In August, after being fooled by Trump, who said we had a trade deal where they're going to buy agricultural products, a month later he came out and said that there was no trade deal, that the Chinese are not living up to their bargain. Now this time around, we are seeing purchases of soy, tariffs being removed. And so it does look like China is going to play ball for the foreseeable future. So that's what this current prediction relies on, is that they do play ball. And we're really just fighting the gravity of yields rising in the bond market and the stocks. July was our only loss. I was expecting the trade deal to break down. The thinking was that if Trump did want to create some chaos, and that was my thought all year, if he did want to create chaos with China, he should do it sooner than later so that he could resolve the problem at some point in 2020 and avoid a recession in the US to have better odds of winning the next presidential election. And so he kind of just did a big cat fight with not a whole lot of real escalation, a lot of rhetoric, but not a whole lot of real escalation. So perhaps this will be put off to 2021. Our current trading plan is to trade the SPY Monday, Wednesday, Friday, emerging markets on Tuesday, and the TLT and GDX on Thursday. Now, we're not just outright long these positions. We have put options below each of these assets, which makes it incredibly difficult to have a large loss in a short period of time. And as you can see, our largest loss over the past 12 months is only 1% in a single month. Now, the catch is to have the ultimate safety does make it a little bit slower to generate returns because we're often fighting the cost of our put option with our market prediction to generate a profit. So this is really ideal for retirement accounts who want to generate safe, consistent returns with extremely low volatility. If you're a younger fellow who wants to get 20% plus returns per year, you're probably not going to like this strategy, as we're aiming to generate between 12 to 15% a year with extremely low volatility and with an uncorrelated basket of assets that can help us generate a profit in all market conditions. Now, the next part of your trade alert shows you how to get out of the previous trade. If you did not take the previous trade, you can skip this step. So just a visual of how to get out of the previous week's trade: buy to close your December 27th 134 call, and sell to close your January 3rd 137 put. Now, to roll into the next position, we're going to sell to open the January 3rd 135 call option and buy to open the 138 put. So this is a credit of 17 cents. And if we look at the risk graph, we can see going left to right is the price of the TLT, and going up or down is the value of our return. And so in this chart, we hit the maximum profit of $1.64 per share, which is just over 1% week over week, if the TLT goes below 135. On the other hand, we hit our maximum loss of $1.35 a share, or just about exactly 1%, if the TLT travels above the 137, or rather the 138 put that we've purchased. So I'll pull up a live chart of this so we can take a look at it. And so we can see with a little more detail in this blown up chart, the two outcomes. If the TLT travels lower, we generate a return. And if it travels higher, we generate a loss. So it's a pretty simple setup. And I do expect us to place this trade for the next several months, perhaps all the way through November, until it gets to a yield that could actually become a negative for the stock market and create a massive reversal, which also could cause the Fed to cut rates and get control of the credit market. So this could be a trade we can put on for at least several months. We'll see how fast this plays out. Now, if I do pull up our GDX risk graph, we can take a look at how this works. I was waiting to see the price action really show us that this is the right move. The basic idea is if we have low interest rates and we have central banks increasing the money supply, and we also have governments spending more than they collect in tax receipts, this essentially forces central banks to buy up government debt and expand their balance sheets. So if we're expanding the quantity of money and the amount of gold is staying relatively stable or slowly growing, well, that's going to make the relative value of gold go up. So that's why we want to be long the gold miners in this period of time. So with the setup, if you're just starting to follow the program, you're basically paying for your downside protection when you enter the position. And in our case, we hadn't seen this big move yet. So we bought a pretty hefty $28 put. Now, if you're just following now, that $28 put only costs 18 cents. I actually paid $1.15 and have had to work that off. Now I got in around 27, you're jumping in at 29. So your maximum loss on this is $1.24 per share, which is a pretty big risk. And this is by far the riskiest portion of our portfolio. So to generate a profit between now and January 10th, if you're taking this trade today, you're going to need GDX to go up at least 18 cents, the cost of your put, to break even. And then anything after that will be in the green. So that's our setup on GDX. And the metals continue to be the piece of our portfolio where I'm willing to take the most risk because I do think it has the longest run up for us in our portfolio, considering what's happening in global finance. So to enter that trade after purchasing your 100 shares of GDX, you have to purchase a $28 put for downside protection. Now, if you want a lot less volatility, you could consider going to the $29 put, but just realize you can have a lot more upside before you pay off that put. So now that we are seeing indications that we have all four central banks, Bank of China, the ECB, the Fed, and the Bank of Japan doing two things. One, fiscal spending. Two, quantitative easing. That's the best scenario possible to be long gold. And so once again, you have your risk chart on that. Now, I'm going to pull up our trading plan. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement, income and safety, not growth or speculation. This allows you to simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. And we really have three go-to trading plans that helps us navigate the markets. If we're in a de-escalating trade war, which is where we're currently at right now, our strategy is to be long SPY, emerging markets, and gold, and then short bonds. And so you can see the negative next to the TLT. And I think this is going to play out for quite some time, at least several months. We'll take a look at the yield curve in a little bit. At some point, I do believe we will be back to either an escalating trade war or this exact setup you're looking at, simply because yields will get so attractive in bonds that it does start to pull money out of equities and back into bonds. Right now, we have the exact opposite. We have a whole lot of money that's been malinvested into bonds that have no return compared to inflation. And now they're negative because yields are starting to rise. So I think we're going to see a whole lot of money flooding out of the bond market and rushing into stocks. So probably the next few months, we'll see the most aggressive sell-off in bonds and rally in equities. And as the yield on bonds gets more and more attractive, I'd suspect that the growth in the SPY slows down, the crash in the TLT slows down, and creates this antagonism between the two. Now, to play these different conditions, we have really three basic setups. We have our bullish loose option caller, and this is where we sell an out-of-the-money call and buy an out-of-the-money put. It sets us up for the biggest risk and the biggest return. This is great right after an asset has had a significant sell-off, and we think it's a relatively safe time to let the asset appreciate all on its own. The setup we're doing currently is a hybrid of the neutral tight option caller. This is really good if you believe the asset's overpriced and could have a significant sell-off on any bad news. So that's what I think the SPY's at right now. But we're throwing in a call option on top of this to take advantage of low volatility. So we're actually able to dramatically reduce downside risk while not underperforming the SPY. So we're adding this chart exactly plus a long call to take advantage of low volatility and to have very low downside risk. So in our bullish caller, we can lose $3 a share or 1% per trade. In a tight option caller, we're reducing that risk by 66%. So we can only lose 1/3% if the SPY were to go down any amount. On the other note, because we have that at the money call option, we can generate a profit if it just trades flat or up. And finally, the bearish inverted option caller allows us to own the asset and generate a profit to the downside. So this is currently our setup on the TLT. And to do this, you just sell an in-the-money call and buy an in-the-money put. So this actually allows you to profit safely from a downward move while owning that asset. Okay, guys, that's a good review of our portfolio. I'm going to go ahead and open it up for questions. And we'll probably have a relatively shorter presentation today. I do want to pull up one chart while we see if we have any questions out there. Let's see who we've got live. Karen. Oh, yeah, let me hit all the unmute buttons. One sec, guys. How's it going, Karen?
Hey, I'm here. Sorry, I've had a few distractions already, so I'll have to re-listen to some of your presentation. But good morning.
Good morning. Oh, that's great. You have a good Christmas?
Busy. I'd like to go back to sleep and recuperate, but you know, not yet. Yeah, but thank you. You had one as well.
Yeah, we had a great one. It was fun. We had the whole family at our house, so it was a zoo, but glad to be back in the saddle now.
That's good.
Now I see one user who's registered as an email guest with their microphone open. You have any questions? I'm going to go back to 2018 and show you what happened to bond yields so you can see visually what I suspect is going to happen in the next several months. Why is gold and stocks going up together? Sure. Yeah, I'll definitely review that. But yeah, I suspect we will continue to see stocks and gold go up. Here's a look at the Treasury curve in 2018. So this is the January Treasury curve. This is the April, this is the August, and this is the October. And if you remember, it was right before October when we had this massive sell-off in US equities all the way through December. Now this yield curve was being pushed up because they were hiking interest rates and doing quantitative tightening. But what happened right after that was we cut rates into 2019 and we had this massive over speculation in bonds because of the trade dynamics between China. So there's a ton of money now stuck in these losing bonds that's fleeing out of the bonds as they're waking up and realizing that there's no rate cuts planned. So there's no reason to expect rates to go lower. And at the same time, the biggest fear in the market's been removed, quite likely for all of 2020 going into the election. Now, could China or some other surprise come out of the blue? Sure. And that's why we always have our put options. But it was right when this 10-year yield went over 3% that the banks went out of stocks and flooded into that 10-year treasury. So the basic idea for a banker is, okay, wow, I can get 3% a year for 10 years guaranteed. Plus, I know that that's a level that will cause some disruptions in stocks. So I can anticipate that the Fed will come in and cut interest rates to help support the stock and credit markets. So what happens right when they do that? Well, these interest rates go lower. So you can see that's exactly what happened and drove these yields really low into 2019. In fact, we got all the way down from, on the 10-year, we went from 3.15 to 2%. And so that represents a massive gain. If you were to just flip the bond, just buy it at 3.15 and then flip it at 2. So they're getting quite a sweetheart deal anytime that yield gets too attractive. Because one, you have a guaranteed profit against inflation for 10 years. So it's risk-free in that respect. But two, if you anticipate that this will cause a lot of people to exit stocks and buy the bond position, well, then the Fed has a good reason to try to save the markets by cutting interest rates. So that allows these bond buyers to sell those bonds for profit and go right back into stocks. It's almost like clockwork. This plays out over and over again. So here's where we're at currently. We have the Fed buying up the front end of the Treasury curve, which you can see is much lower and being artificially kept low. But meanwhile, we can see the longer term rates are starting to float up. It's almost like you got a person on the ground holding a kite. And my expectation is these rates will steadily rise. And once that 10-year, I don't think it'll even make it to 3% this time. Probably 2.8% will be enough to get a reversal where stock money flows out of stocks into bonds and then gives ammunition for the Fed to cut rates even lower and get these credit markets back in check. Okay, so gold, why is gold going up? Well, because there's no end in sight to money printing. We have 4 central banks doing two things. One, we have them spending more than they collect in tax receipts. So we're talking about Japan, China, Europe, and America are all running deficits at the government. So that's creating a demand for finding someone to sell these bonds to. And there's just not enough people who want to buy these bonds. So the central banks are forced to buy up these bonds. And that is increasing the money supply. So if the amount of gold is staying relatively flat, but the amount of fiat dollars is rapidly increasing, well, then that's going to make the relative value of gold go up. So until there's a fear that rates are going higher and that deficits are going to get under control, I think we have quite a nice ride on gold. So let's take a look at that. Last time we did quantitative easing at this pace was at the very end of 2008, after they had cut rates. So we did the rate cuts in 2019, just like we did in 2008. And now they're going into full-blown QE. So QE is what really drives these assets up. And we can see last time this happened, GDX went from 21 to 65. Now the problem today is far greater than it was in 2008. So I don't think we will see this chart end at 60 this time around. So this is actually my favorite position and the one that I'm willing to take the most risk to capture the biggest return. It's only 10% of our portfolio. So it'll be hard for us to get absolutely murdered on this position, because not only do we have put option below the asset to protect against any volatility, we also have a relatively small position of only 10%. Now, in our boot camp, Murray was asking me if I thought we would go to a gold standard. No, I think all the other central banks will have a huge 10%. That's actually what they have right now, is about a 10% position at most central banks. But I think what will be America's move eventually, hopefully, will be to hike interest rates. And that's what will tank everything from stocks to bonds to gold. And that will entail having to have a recession, high unemployment. We're gonna have a lot of bad companies going bankrupt, but I think that would happen before America said, hey, we're not gonna think of the dollar as the ultimate currency. We're gonna think of gold as the ultimate currency. So I don't think that will happen. But until they do start talking about hiking rates and slowing down the growth of the money supply, gold should go wild. All right, guys. Well, I was planning to do a little bit. Okay, how high will GDX go? I think it's going to go above 60. Now, in terms of timing, I'm expecting modest growth in gold in 2020, and then exuberant growth in 2021. And the reasoning why is because, once again, my expectation is the Fed will let these yields go up, which is going to help fund our government deficit, which is tremendous. It's $1 trillion plus deficit. So the higher these yields go, the less the Treasury, the Fed, is going to have to supplement the bond market. And so this is going to be very nasty for emerging markets, bond markets, because they're looking at, low yielding bonds that are underwater. And then they can look over at the US for some pretty premium yields on bonds. So my expectation, again, is the Fed will keep printing at $60 billion a month, supporting the front end of the curve. They'll probably keep expanding the repo markets, which are just like a temporary expansion of their balance sheet. And they're going to do this until these yields get around 3% on the 10-year. And at that point, I think we will see a big sell-off in stocks and the Fed coming in to try to get these yields to go down by showing guidance that they need to cut interest rates. After they cut interest rates, give it a little bit, then they tend to go into quantitative easing. And that's when I suspect they will move off the front end of the curve towards the middle and long end. And they like to do this accompanied with a crisis. So timing wise, it seems quite likely that this all could play out in the bulk of 2020 into the election. And then we re-engage into a trade war with China to try to get some more of our demands met, which will give them great cover for cutting rates to zero, going into a more aggressive period of quantitative easing. And that's when I think you get your big push in gold. So yeah, my expectation is good growth 2020, great growth 2021 for gold. Now, what's going to, once again, be the end of the gold run? That will be after they start to see fears of inflation and react to it. Right now, they're saying they're not going to even react to inflation. But the axe would be when they start to hike interest rates and perhaps even do quantitative tightening like we saw in 2018. Right now, that just does not seem to be on the table whatsoever. So that's why we're starting to see people begin to front run what we're expecting will happen in the next several years. Any other questions? You have you've always had a lot of gold in your portfolio, haven't you, Karen?
Yeah, I've got more physical though. So
okay, so you got a little bounce, but not that 10% we just picked up on GDX.
no, and I'm not quite back up to where I purchased it. So, it's okay.
Oh man.
Well,
Well, do you have the GDX position at all, or you just got the emerging market so far?
Oh, I have that too. Yeah.
Oh, okay, good. Well, that's good.
Yeah. I went ahead and jumped into that one a couple weeks ago. So that was, I was telling you I was going to get it, completely on track. I was waiting for some of those old mutual funds to go ahead and put their capital gains in, and because they don't post for a year, and then I got rid of some of that, so this way I could go ahead and realign. So that's what I did.
Okay, good. Okay, we got a new question. New to options, can you explain in the money? Yeah, and also I will throw out, if you do join our program, we're giving you a 1 month free bonus into our boot camp, where it's just like tennis practice, not just watching the replay of a good tennis player. You're actually going to get out there and we're going to hit the ball together. But yeah, let's just review those the 3 types of trades. So out of the money just means it's away from the current trading price. At the money means it's right at the trading price. And in the money means it's actually below the trading price. So I'll just walk you through these 3 slides so you can really get a feel for it. So in this setup right here, this is our bullish loose option caller. And again, it's ideal if you really have no fear of a big sell-off. So this is a great setup after a large sell-off has already occurred and you think you have a pretty clean ride ahead. Now, currently, I don't feel like that's the case. I do think the SPY is going to rocket higher into the year, but I do think there's a high level of risk of sharp sell-offs and high amounts of volatility, and it certainly didn't just bottom out recently. So we've kind of done something weird. Normally, we're all trained that we do rate cuts into a recession. Sure, they do that every time, and they're usually able to predict a recession before it occurs. But we don't do quantitative easing until there's been a big sell-off. So this time around, we had no big sell-off. We've done rate cuts, and now we're doing quantitative easing. So this is pushing stocks much higher, and they haven't really had any pain yet. So That's why I'm not doing this trade setup, even though I'm very bullish on stocks. And because of the Fed's action, it's made the volatility index super cheap, which means buying call options is cheaper now than it really has been for most of 2019. But let's just look at the terminology. So if I sell the 301 call, that means I'm short that position. And essentially, I'm agreeing to sell my shares for the strike that I sell the call option at. Now, when this screenshot was taken, the SPY was at 298. So I'm agreeing to sell my shares for 301. Great deal. That's $3 above the trading price. And I would keep the 33-cent credit. Now, on the other side of the trade, I have purchased the 295 put. So I'm long the put. Now, on that setup, someone else is agreeing to pay me $2.95 a share for all 100 shares of my SPY, no matter how low the SPY goes. And for that right, I have to give him 46 cents a share. So in this example, our maximum loss is if the SPY goes below 295, that's the maximum loss because we have a put option that guarantees us $2.95 per share. Now, on the other side of the trade, if the SPY goes above 301, we no longer enjoy profits because we've agreed to sell ours for 301. So that's the out of the money call that we're selling to collect income. And then the out of the money put we're buying for downside protection. So does that make sense so far before we go to the next slide? Okay, I'll go ahead and continue the next.
Sorry, can I ask a question?
Yeah, please.
Oh, sorry. Just a new to options. So you said that the what the in the money call is below the stock price.
So an in the money put is above the trading price, and an in the money call is below.
Oh, okay. Thank you.
Yeah, sure. So, so here's your in the money trade that we're doing on the TLT. This is a SPY example. But yeah, call options, if it's in the money, will be below the strike price, and a put option would be above. Now, if it was out of the money, it would be like this.
No.
I went over,
Diabetic.
yeah, picked up the, said, oh, I was gonna pick up the whipping cream. Jerry said it went with mad. She just-
Oh, had a little background noise. Let's see, any other questions out there today? Just use your chat box or raise your hand if you do. That way we don't get the background noise. All right, guys. Well, I appreciate everyone joining us the day after Christmas. We'll go ahead and let everyone off the hook a little early today. I'll probably have a little bit longer presentation tomorrow, and then we'll be back to our full-blown hour-and-a-half, 2-hour presentations next week. So thank you so much for joining us live, and that is a wrap. If you have questions, please feel free to email support, and otherwise we'll see you tomorrow live. So thank you so much.